monthly stock market momentum, the Mag 7 reports, and metals on fire. I quantify it all on today's REKTelligence Report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the All Markets Report, where I quantify current market action with an eye to the week ahead. And there is a lot going on. This should be a fun episode, so let's get into it. Excited to get into this week's key themes, which will be a recurring feature of my Monday All Markets Report from here on out. So let's get into this week's. First of all, my top theme is that monthly index momentum in the equity space looks likely to continue. I'll show you a study across the S&P 500, the NASDAQ 100, and the Russell 2000 that suggests that. And theme number 2 is that we have 4 of 7 Magnificent 7 or Mag 7 companies reporting this week. That certainly could lead to some dislocation and volatility in the index returns this week. They are, of course, highly influential stocks among the averages. So we could see kind of a tension between an above average performance or a below average performance in one of these names after it reports and its effect on the index. Let's move to number 3 for the week, which is metals on fire. We've seen incredible momentum across the metal space, not just precious metals. And we will look at a study of massive stretch percent readings showing this extreme momentum. Number 4 is demand drivers for metals. They are a number of factors. We'll discuss them just here, not really quantify them, although we're quantifying everything else. So the AI build-out, of course, is one of the main drivers. There also has been underspend in CapEx for many years. That is reawakening, driven by the AI trend primarily. And lastly, I think there's some degree where the threat of a non-independent Federal Reserve is driving metals as well. Now, do I have the attribution for that? No. That is something that'd be pretty difficult to quantify, but a non-independent Fed means that rather than evidence-based policy, you are now invoking or implementing political policy and making borrowing easier money that is inherently inflationary. And I think there's some degree, could be small, where that is influencing commodities right now. Now, metals caution is theme number 5. With a 12-month hold, I'm going to show you that there's a kind of a mixed picture out there for metals, despite the momentum we're seeing right now at the end of last week and perhaps today. I'm recording this on Sunday prior to release. Number 6 theme is the dollar. US dollar dumped last week and it closed at an 80 or 80 plus day low. I'll define that shortly. This is historically bearish. So let's get into all these areas and have some fun. Let's start with the stock market. And I'm going to move to this chart of the S&P 500 index. This is a monthly chart, so it covers a wide range of time. And I'm going to test 2 very simple conditions. First is that the S&P 500 index on a monthly basis closes above its upper Bollinger Band. So its upper monthly Bollinger Band. And Bollinger's using the standard settings of 20 MA for the middle band and 2 standard deviations. And the second condition is that the S&P 500 closes 15% or more above its 20-month moving average. So that's it. Those 2 conditions, a close above the upper monthly Bollinger Band and at least 15% stretched above its 20-month moving average. When have we seen that last in the S&P 500? Well, in this chart, it was at the end of September. So we got a so-called buy signal using this query or this test, these 2 conditions, in other words, pretty recently. And we have moved up since. Let's look at the stats using a 12-month hold. So in other words, when these conditions are met, hold it for 1 year and exit. What does that look like? Well, there have been 30 instances of this setup with the data I have for the S&P 500 on a monthly chart. And the profitability or hit rate is 73.33%. So there are times where this doesn't work out, but the majority of the time, 73.3%, it has been positive 12 months later after these conditions are present. The profit factor, this is really impressive, which is 8.467. Basically, call it 8.5 or very close to 8.5. This means that the amount of profits here, hypothetical sum of gross profits divided by the hypothetical sum of gross losses, is 8.5 or very close to it. Profits are almost 8.5 times greater than losses here. So this does have a strongly bullish tilt. And break-even profit factor is 1.0, as many of you might know already. So this is well above that, really an excellent number, especially on so many instances. Now let's move to the NASDAQ 100 index. I've got a monthly chart of the NASDAQ 100 index, and I've got the same two conditions I want to test. Once again, the NDX closes above its upper monthly Bollinger Band and at least 15% stretched above its 20-month moving average. Let's look at the stats with the 12-month hold. By the way, this signal for the NASDAQ triggered a little bit before the signal for the S&P. So last summer, I believe it was July, that this triggered, and therefore the signal will be open, if you will, through June of 2026 this year. So what are the stats? Well, there have been 14 instances of these conditions being met. Profitability or hit rate is 78.57%. So again, sometimes it loses, but majority of the time, nearly 78.5% of the time, it is producing a positive result. And the profit factor here, once again, is very robust, 4.928, not quite as good, of course, as the 8.5-ish of the SP 500, but it's really excellent and strong here for the NASDAQ as well. Worst drawdown for both the S&P and the NDX was in 1987 into 88. There was a signal back then, and in between those two times was Black Monday and the crash of 1987, which is legendary. And I've talked to many traders who lived through that. That was just before I started. I started in the mid-90s, but definitely worth learning about that time. So interesting that one of those times was that 87 crash, but this study doesn't necessarily correlate with that very unique instance of the 87 crash. All right, let's move to the Russell 2000 index. And this is one where we are testing those same two conditions. And if I look at the stats with a 12-month hold, and by the way, this might create a signal this month potentially because the stretch percent is great enough and it's currently above its upper monthly Bollinger Band. So again, the Russell 2000 may signal this. There's no open signal, but it may signal this in just a handful of days here as we wrap up November very soon. So what are the stats here? Well, there have been 10 instances historically, and 60% of the time, 6 out of 10, they have been positive. Profit factor 2.491, not quite as robust as the NDX or the SPX, but again, the tendency here across equities with these conditions, two of which signaled last year, and the Russell, which could signal at the end of January this month, all suggest positive future returns. Again, don't rely on that, of course. Nothing here is investment advice, but knowing history is really a great way to inform your own investing and trading. All right, let's move on to earnings. It's earnings season, everybody. Get ready. We have a lot of the Mag 7 reporting this week, as I mentioned. You are looking at an image of my earnings performance analyzer. This is an app I created to do what I always wanted to be able to do easily, which is analyze historical stock performance after earnings to uncover trends and patterns and so forth. So I hope to get this out to you by Q2, and I appreciate all of you early viewers and early listeners a lot, so thank you. And I'll find some way to reward you, give you access to this, or give you a special price, or whatever the case may be. So again, thank you. Spread the word, and I won't forget to do that in one form or another. So let's get right into Tesla. We're looking at the one-day return historically, going back 10 years. post earnings for Tesla, which reports Wednesday after the close. So the average one-day return after earnings is negative 0.31%. Now, that doesn't sound like a big deal. On the downside, it's a pretty small number. You can see, though, looking at the distribution chart, there are some very big days to the upside as well as the downside one day after earnings. The best performance over the past 10 years, a day later after earnings, is positive 21.92% for Tesla, and the worst performance, negative 13.61% for Tesla. It's down 55% of the time. In other words, the hit rate or win rate is only 45% of the time, so it has a slight negative tendency, and that goes with obviously the average one-day return. Let's look at the trend going 1 day, 5 day, 10 days, and 30 days out for Tesla after earnings. So you're looking at this chart with just 4 data points, the 1 day, which we already know, to negative 0.31%. Average return. The average return over 5 days after earnings for Tesla is positive 2.98%. 10 days out, it's positive 3.93%, and it is positive 6.88% 30 days out. So Tesla does have a very strong post-earnings trend, and that is something to keep in mind. Now, this next earnings date this week and what follows could be completely different than what you're seeing here. This is the historical trend, but again, not every instance is going to fall in line with the overall probability. Now, that is something that's always the case, but when you look at probability, you're getting the historical trend, and you can always take into account the fact that there is a risk it might deviate the next time around. So again, keep that in mind going forward. Meta reports also Wednesday after the close, and we see the post-earnings one-day average return for Meta is positive 1.11%. The win rate, 55%, so it's positive the next day, a bit more than it's not. The best performance 1 day later for Meta over the past 10 years, positive 23.28%. The worst performance, negative 26.39%. Let's look at the earnings trend. Once again, 4 data points, 1 day, 5 days, 10 days, and 30 days out. And we see that 5 days out, it's a little bit higher than the 1 day return. So 1.81% 5 days out on average. 10 days out, it dips a little bit, still positive 1.41%, and 30 days out, positive 2.48%. Let's move to Microsoft. Also, you guessed it, Wednesday after the close. Average 1 day return post earnings is positive 0.80% over the past 10 years. And the win rate here is a little bit higher, 60% of the time it's higher. Best performance, positive 7.63%. Worst performance, almost the same, negative 7.72%. Let's look at the trend again, 1, 5, 10, and 30 days out from Microsoft post earnings. The 5 day return is an even 1%. 10 days out, it is positive 1.77%, and this image got cut off, and I don't have the 30-day number on the chart, but I will put it in text over this video when I edit it. Apologies for that. Let's look at Apple, which reports Thursday after the close, just to be different, as the slogan goes. And you can see the average 1 day return for Apple is a positive 0.99%, pretty strong. Win rate is 50%. So it's a coin flip there. Best performance 1 day later after earnings over the past 10 years, positive 10.47%. Worst performance, negative 6.63%. Let's look at the trend. We have all 4 data points here as expected, and we can see 5 days out, it's a little bit better, 1.58%, 10 days out, 2.59%, and 30 days out after Apple reports, again, over the past 10 years, positive 3.36%. Time to talk commodities, and of course, I'm going to start with the high-flying metals complex, specifically silver, and I'm looking here at a chart of silver futures on a monthly time frame, which just hit its highest stretch percent reading since January 1980, when silver was stretched over 216% above its 20-month moving average. Really incredible. That, by the way, put in the high for silver for decades. Now, fast forward to the end of last week, and silver was stretched 149% above its 20-month moving average. So what's my perspective on this? Basically, we're not quite as extreme as we were in January 1980. There's no reason we have to match that extreme. We could get more extreme or not quite as extreme. But I'm certainly going to be on the lookout for a possible blow-off top if silver and likely other metals don't pause, right? If we continue to get this momentum without any pause, this euphoric greed-fueled rise, that would be a concern for a potential top in silver. If we get some consolidation, that can work off the extreme and better be more conducive to a longer trend. So that is just an observation I wanted to share. Now let's look at a quantified study of silver. I looked at two conditions that are going to be familiar. A close above the upper monthly Bollinger Band, that's condition 1, and condition 2 is greater than or equal to a 100% stretch above the 20-month moving average. So this is a variation of what we tested on equities earlier in this video report, but more extreme, of course, for silver and a couple metals that will follow. There have only been 3 instances of this happening in silver, and one of them closed out, by the way, with a 12-month hold. That is very important to add, that I'm buying silver, hypothetically here, with these 2 conditions when they're present, and then holding it 1 year and exiting, all right? So it's a 1-year hold or 12 months, and we see one of those instances closed out in 1975 with a negative return. So despite these euphoric conditions, it nevertheless ended a year later down negative 23.21%. Again, that was 1975. One closed out in August 1980, and that was a positive 26.49% result. Lastly, the most recent instance of this occurring was in 2012, when it closed out with a negative 36.18% return. So we don't have a lot of data here. These are very rare conditions, so we don't have statistical significance we can rely on, but we do have some observations, and that's why I'm sharing them. So let's move to aluminum monthly chart. Same conditions I just covered. If aluminum closes above its upper monthly Bollinger Band and greater than or equal to 100% stretched above that 20-month moving average. Now, this happened for aluminum several months ago, and it has moved higher. Historically, we have one instance that closed out in 2022, negative 14.7%, and we have one that is currently open, that's open with a net P&L as of the end of last week of 66.3 and change percent. So again, not a lot of data, slightly skewed to the positive, but of course we haven't completed 12 months here. That will happen some point this year. Let's look at platinum, and with these same conditions, no trades. So we don't have a historical analog for platinum at all. This is clearly uncharted territory for platinum on a monthly chart. Let's move to palladium on a monthly chart. And we just got a signal. I changed these conditions to generate something here for palladium. And if palladium historically is closed above its upper monthly Bollinger Band and is greater than or equal to 50% stretched above its 20-month moving average, we have 6 times that this has occurred. And the total P&L is flat-ish, but it slightly tilts negative. So there's not a big bullish or bearish edge here. The total P&L would be negative 9.2% here over those 6 prior instances. Going to wrap up this week's All Markets Report with a macro update, and I'm putting the dollar's very weak close in this category. Now, the dollar index, or DXY, just closed at a multi-week low. We see the stats here with a 3-month hold, or a 90-day exit. So once again, dollar closes at an 80-day low or more, and then buy the dollar index and sell in 90 days. What are the stats? Well, going back into the late 60s, we see that the total P&L for this query or this test is negative 61.66%. And there have been 67 instances in which this has occurred. The profitability is 35.82%. It's very low. And the profit factor is extremely low at 0.432. Thank you for watching and listening, everyone. Really appreciate it. Feel free to reach out to me at david@tradingfromparadise.com. I'd love to hear from you. And of course, I'd love it if you could subscribe, REKTelligence.substack.com. I issue twice weekly video reports quantifying the current market. And on Thursday, in the Edge report, I will be quantifying opportunities in individual stocks, crypto, and more. So stay tuned for that. Have a great day, and I'll see you in the next episode.